CapstoneLaw's private market roundtable infrastructure investments. My name is Hans Moritz. I'm a partner with CapstoneLaw Zurich, and I have the pleasure and privilege to be the moderator of today's panel. Infrastructure is a key driver of economic growth. Infrastructure as an asset class has grown substantially over the last couple of years. The investor universe has not changed significantly in recent years, we believe, but the overall pool is expanding as investors look to infrastructure for stable returns and a tool to diversify their portfolio. Over the next 45 to 50 minutes, we will discuss with key industry experts from Switzerland, Europe, and the US, trends on infrastructure investments and infra fundraising across different regions and different asset classes. May I introduce you our amazing panel. Let's start in the US. Daniel Galinko from JP Morgan. He's based in New York as an investment specialist in the infrastructure investment group of JP Morgan Asset Management. He's looking after investments as well as fundraising activities. Prior to joining JP Morgan in 2017, he was at Stepstone, where he was basically serving on the investment research team, conducting due diligence on primary funds, secondaries, and co-investments. Before Stepstone, he worked at Oppenheimer and the private equity fund of fund and co-investment area. From Edmond de Rothschild, we have Jean-Francis Touche. He's Global Head of Infrastructure, Real Assets and Structured Finance, and he's CIO of Infrastructure Debt Bridge. Before joining Rothschild, Jean-Francis held various positions with UBS, Citigroup, and West LB. From InvestInvent AG, we have Grant Harper. Grant is CEO of InvestInvent AG since 2005, and he's responsible for fundraising and fund investments of a wind energy investment program. Before 2005, Grant worked for a number of large financial institutions. From Swiss Re, we have Nitesh Mistry. He's based in London and with over 18 years of experience in infrastructure finance across all different infrastructure assets. He's responsible for originating, structuring, and managing infrastructure debt opportunities in the UK and in Europe. Before Swiss Re, he worked at Deutsche Asset Management, Bank of Tokyo, and Royal Bank of Scotland in different roles and functions in the infrastructure space. From Partners Group, we have Robert Jan Bakker. He's based out of Zug, and with more than 13 years of industry experience, Robert Jan is a member of Partners Group's European private infrastructure business. He's active both in deploying capital in infrastructure investments, as well as raising capital from different client types. Prior to joining Partners Group, he worked at APG Asset Management and Deloitte. As to my person, I'm a founding partner of CapstoneLaw. CapstoneLaw is a law firm specialized on structuring and forming all kinds of fundraising, fund and managed account vehicles for all types of asset managers and investors, including pension funds and insurance companies. And we are helping on investments across all illiquid asset classes such as private equity, private debt, infrastructure, and real estate to make sure investments have strong investor protection are being optimized for the individual managers and investors. So welcome to all the panelists, and thank you very much for joining that amazing panel. Maybe let's start our discussion in the US with Daniel. I mean, Daniel, you at JP Morgan, you're running a large infrastructure core plus platform. Could you provide us a description on the JP Morgan infrastructure business and how you are basically invested from a generic perspective?
Yeah, absolutely. And thank you for hosting. Can you hear me properly?
That perfectly.
Okay, great. Well, thank you very much, Hans, for having us on and for putting this panel together. And thanks also for choosing, I guess, an afternoon European hour to accommodate us here in New York. Great to be with you. So in terms of the JP Morgan infrastructure platform, we are an OECD-focused investment platform. We're core plus, as you mentioned, and evergreen in nature. So really, we're trying to buy assets, own and operate and optimize over the longer term. So that's our basic strategy, sole strategy on the platform here at JP Morgan.
So in terms of your core investment strategy, could you please elaborate a little bit more on what is your kind of core target, what you're trying to achieve with your investment activities?
Yeah, from a simple kind of generic perspective, our belief is that core infrastructure assets are essential for local communities. They provide relatively high levels of EBITDA margin, cash flow predictability. So really our objective is to deliver what you would traditionally find in a core real estate or other core sectors in terms of return profile, which is very predictable cash income and a focus on delivering that income through market cycles, sort of regardless of what's going on in the general market, stock market, et cetera. So that's really the focus and the purpose of the strategy.
And in terms of your investment philosophy, I mean, you're an infra core platform. I mean, what are the key fundamental investment principles of your investment philosophy?
Sure. From a high level, our investors are coming to us looking for very predictable forms of income. And in delivering on that objective, we're needing to find assets that have very sticky forms of income. So we tend to find those through very contracted profiles. Often that's contracted power. We're also investing in highly regulated businesses. So again, regardless of what's going on in a Corona kind of economy or in any other type of market environment, whether I'm working from home or in JP Morgan's headquarters in Manhattan, we need essential service, water, electric, heating. We're in the middle of probably the coldest winter we've had in a while. So again, the essential nature of these services tend to correlate with, again, high predictable income and forecastable yield that our investors are targeting.
I mean, in terms of the U.S. Infrastructure landscape, I mean, what we see is typically that there's kind of a trend to very large deals in the U.S., right? It's maybe a little bit different in the U.S., but what kind of trends do you see in terms of ticket size, in terms of how the deals are structured, whether people are basically co-investing with other people? I mean, how do you see that development?
Sure. Well, it's a very deep and broad market. If you sort of sum up, it's tempting to think of infrastructure in the same way that you think of corporate private equity or private real estate, in which private investors are a material representation within the overall capital stack. In infrastructure, it's quite different. You have, if you were to sum up the capital base of all the public utilities, all the government-owned infrastructure, all the private equity and infrastructure formed equity, you actually find that infrastructure funds are a very small piece of the overall pie. It's a market that's trillions and trillions deep. And the other thing that you see is that we have, speaking from a U.S. perspective, done a tremendous job ignoring our infrastructure for generations. So there is just a tremendous need to invest in upgrade overall quality of the infrastructure landscape and key assets here. So you do find, to your point on kind of size of deals, yes, there are very large deals. There are large strategics. Berkshire Hathaway is probably our biggest infrastructure platform in some respects, given all the assets that they own. But there's also a tremendous amount of mid-market and small cap investment activity as well. The need for essential services in a small rural community and water services is just as acute as it is in Manhattan. So you do find, and we tend to focus on the mid-market. We think that there's good opportunity and better efficiency in the lower end of the market and in very local markets. Maybe one other small point on this is it's tempting to think of the United States as one government that's looking over the entire infrastructure landscape, but really you find that a lot of the assets in the US are regulated on a local basis. So there's sort of 50 countries, if you will, in terms of the different states across the land. Oftentimes, utilities will be regulated on a very local basis with local communities, counties, municipalities. So there's a very good diversity of overall asset, both in terms of size, geography, and scope.
I mean, you just mentioned that there is a massive need in the US for basically infrastructure investments. I mean, if you prioritize that, in which kind of areas do you see the most pressing needs to make investments?
Yes, well, there's no end to the list. We see the headline stories of critical failures on essential infrastructure services. So unsafe natural gas delivery lines for home heating and customers and businesses. We see that there's been major blackouts due to failing electric utility lines. If you've traveled regionally in the US, our airports are not as quite up to European quality. So really, as you look across the landscape, there's a lot of work that can be done. We're also in the midst of an energy transition. Many of our states have renewable portfolio standards, and obviously with the new administration, there's an expectation that there'll be further impetus for changing our overall energy system to a more green nature. So again, there's just a wide swath of potential areas to invest and where the dollars are needed to genuinely keep up the integrity of the assets.
I mean, you just mentioned that the infrastructure market in the US is fairly diverse, and you have different sectors in different even countries, kind of states in the US, right? But I think you have a lot of money going into different assets. I mean, what does that mean in terms of the valuation of underlying assets?
Sure. Well, each market is different. So, and there's a cycle to it. So renewables are one that's, a good example. There's always sort of a cycle to the overall market in terms of developers, in terms of assets that are hitting the market, in terms of how public markets are treating those assets. The yield co market is still an interesting case study for those that have followed the market. So there's always an ebb and flow, but we do see that there is strong bid overall in the market. Obviously, there's been a lot of capital that's been raised. So our focus, again, really is to find the areas of the market where there are long-term predictable cash flows, where there is a long-term community need for investment in the integrity, transition, sustainability of the assets with changing weather conditions, et cetera. So for us, it's really about finding investments in local communities where there's a need for a long-term partnership to increase the overall quality of the asset base.
I mean, typically and historically, I think infrastructure has been kind of a non-listed asset class, right? But you see more and more kind of listed infrastructure vehicles, listed infrastructure investments. What is your view on kind of listed infrastructure?
Sure. So obviously, listed has a good home in a lot of investors' portfolios. I think what we saw in the past 12 months, nothing brings out the kind of characteristics of the asset class like a true market emergency or crisis. Listed infrastructure did experience volatility that correlated with other listed asset classes. So generally speaking, I think that investors that are looking at the asset class saying, I want non-correlation, I want income, I want some level of inflation protection, didn't necessarily hit on all three of those objectives this year through their allocations to listed infrastructure. And in the US, obviously we have the MLPs are a major area where investors have participated in the infrastructure market. The extreme volatility in the energy market has led to pretty catastrophic outcomes, frankly, in terms of MLP exposure. So I think that investors are thinking more about investing into kind of private markets, long-term oriented and lesser correlated assets as they think about infrastructure allocations.
Yeah, maybe a final question. I mean, you mentioned at the beginning of your statements that you basically that you're running an open-end structure, right? An evergreen structure. I think historically we have seen kind of typically closed-ended funds, right? With fundraising period, with investment period, harvesting over certain periods of time. You run a different model, where do you see the pros and cons of an evergreen structure in the infrastructure space?
Sure. We see it really as pro in terms of our approach. It really depends on the strategy itself. So this is, not to denigrate closed-ended strategies. They are very valuable. We tend to be buyers from closed-ended strategies. A closed-ended, alpha-oriented investment approach is typically going to buy an asset where there's a chance for capital appreciation, either by de-risking, a turnaround, completing a greenfield development program. Usually when those funds do a good job, they're selling a core asset at the end. And we think that core assets are very well suited for long-term ownership and optimization. And there's more we could go into on that. I don't want to eat up into the other panelists' time, but really the goal for a core fund is not to get that capital appreciation, but to continue the business plan and make sure that the asset is performing and thinking about really delivery and enhancement on the underwriting business case around the margins. And in that way, defending the long-term integrity of the asset and the cash yield on a long-term basis. So it should be a permanent ownership model.
Yeah, on the other hand, an evergreen structure always needs to be in a position to provide liquidity at certain dates, right? Is that something which basically hits your performance? That kind of requirement to at least think about potential redemptions?
Yeah, well, in some respects, it's almost like a slow motion mutual fund. So there's going to be a strike of NAV on a persistent basis, quarterly basis in our case, and there'll be investors that are interested or need liquidity on an ongoing basis, and it should be a liquid overall program. So I think, in some respects, the open-ended strategy should offer liquidity on a more flexible basis than a closed-ended strategy, in that you can't choose, or you could choose to sell via the secondary market. But again, the liquidity in these vehicles is something that we put in the hands of the investors on their timing or needs or priorities.
Okay, thank you very much, Dan. I think that was very interesting, and thank you very much for your insights from New York. Jean-Francis, thank you very much for joining. How are things in London?
I will leave some of my colleagues reply. London is in lockdown, and we're just showing here that it was good to invest in digital infrastructure. But yeah, it's sunny, blue sky, so makes me regret not to be able to go skiing like it was planned at the end of this week.
Jean-Francis, thank you very much for joining the panel discussion. You are the head of infrastructure at Mondi Rothschild. Could you give us a brief update on the EDR investment platform of infrastructure?
Sure. Well, we started as advisors, almost 17 years ago, and we decided, once we reached a bit of a notoriety to be a bit more active and finance assets, and we thought that investing, trying to pull some liquidity from institutional investors and deploy their monies into infrastructure debt was probably a good move. So in terms of our business, so we have a 3.3 billion infrastructure debt platform, which is mainly raised from third-party investors. We invest across all sectors. So, the theme of energy transition, digital infrastructure, modernization of utilities, social infra, of course, with a focus on health, education, and transport, actually, even with the green mobility. So all that is part of the sectors we cover. We do project finance, refinancing, acquisition finance. Our geographic reach was initially broad Europe, where we've expanded a bit to OECD. We're trying to become more and more global as we expand and have a larger base of investors.
And in what kind of stages do you invest? Greenfield, brownfield, secondaries? What is your preference at the moment?
There's no preference, because all assets are interesting, whether it's an operating assets or new assets. I guess we can do any, and but we probably focused initially more on brownfield, not because it was our preference, but because we wanted to show investors we could generate yield, and not have maybe the construction period. But when we set up our platform, we really had all the flexibility to do greenfield. So we're totally agnostic. We've done some very complex greenfield assets in the energy or transport sector, including digital infrastructure. We have done also financing of operating asset, brownfield assets like you referred to, but also we're probably among the first movers to refinance at holdco level portfolios. So we are agnostic. We have a very large team, London based, and we try to really cover the whole universe, because probably for us it's also about being able to capture the opportunities when maybe a sector or geographies or the type of financing might enable us with this equivalent risk profile to bring the most yield to our investors.
I mean, I think you're a very active investor, right? So you're one of the investors who are basically the deal and price maker, and you're not basically the pure risk taker. I think you're trying to directly source deals from the sponsor. Could you give a little bit of a flavor of how you source deals, how you negotiate them?
Well, I think when we started that platform 6 years ago, we really wanted to become a true alternative arranger of debt. I think the way you manage to source transactions, because I guess all peers in this infrastructure that space will say that they can originate transactions from sponsors, structure the assets. So I guess it's more the how, as you suggested. In terms of the sourcing, I guess it's down to experience and the quality of relationships you have with sponsors. We're also insisting on the fact that as much as we love them, we don't work for them. We work for our investors. But I think the simple fact that the senior level in my team has 2 to 3 decades of presence in the field, that means you've done at some stage with whatever sponsors, I won't name, one of their first transactions or an important transactions or in a new country or a new sector. And I think so when we started that franchise, it was relatively easy actually to come and say, look, we would like to be one of your arrangers alongside banks or not. And I think we had their trust. And then you start to build a strong track record, and I would say you reestablish the type of relationship you could benefit if you work for a bank, plus with for our investors the benefit of being totally independent in the choice of assets we have. In terms of negotiation, I would say the key thing was to manage what can be sometimes a bit of a schizophrenic relationship, because you work for the investors who back you, they are the clients. But you also need to convince the sponsors that you can put together an effective debt structure. And then you need to negotiate in a different way, because institutions and banks have different goals sometimes, different provisions we want, and you need to adapt it to the specific asset, because each asset is almost a tailor-made piece of art. So I would say you have to be negotiating, understand it, that you have become an asset manager, but then it's really the quality, the experience, your ability to convince a sponsor. I would say business as usual to a certain degree.
I mean, for all infrastructure assets, I think you need to have a certain sense of the financial circumstances, of the legal, tax, accounting environment, all that. But I think you also need to have a certain kind of technical understanding of the actual assets. How do you make sure that within your group you have, before you go into a deal, that you have kind of the right understanding of technical implications of your investment?
Yeah, it's a very valid point. When we set up the platform, we knew it was about credit, it's fixed income, it's about structuring deals, it's financial engineering. But for us, what was important was to really implement the ESG aspects. We can come back to it later. understand the regulation, which we had because we advised a lot governments, but also I always say that the first security, especially when you're on the debt side, is to understand if an asset makes sense from its industrial technical definition. And here it's down to expertise and experience maybe. So I used to work for a sponsor before I moved to banking in the late 90s. Some of my guys who cover telecoms or energy have that background before they worked for banks and became asset managers. And I think we're not the engineers who will design the next offshore wind plant or the next road or telecoms network, but we will have experience the operational problems or how the issues you can face during construction. And I think that's how then you can probably structure some of the covenants with perhaps or even some voting rights with perhaps an angle that adds protection to our investors.
I mean, with regards to covenants, I mean, have you seen, I mean, you have started, I think, your platform in 2014. I mean, have you seen certain trends with regards to covenants, with regards to protections, which you're trying to get? I mean, are there specific trends to basically control the borrower in more detail, or how do you see that?
I'm not a believer in trends because I believe, especially when you represent institutions, as much as you need to bring the assets to a certain risk profile, whether it's investment grade or BB for the more junior piece of debt we structure, I think each asset is a new challenge, and each asset have specific requirements. And I think when you're an asset manager, even if we raise 1.5-2 billion a year, the market is in dozens of billions, so you can be selective, and so you are in a position where you can hold the pen of the term sheet, and yes, you don't have to compromise on covenants because we're not playing the volume game. So I would say that maybe if there was one trend, is it has been in terms of the strength of the structure, the rigor in the way we structured assets and the covenants we obtain or security package we obtain. I think it's been business as usual for the last 6 years, but very protective of investors, of course.
I mean, I think you mentioned it. I mean, you in the meantime, you have grown to a massive platform. I mean, you are among the top 10 players globally. How many deals do you see on an annual basis, and in how many deals do you actually invest? I mean, what is your kind of filter rate?
Yeah, so tell my top management that we're massive. I think we are growing. It's nice to be in the top 10, but 3 billion plus is a lot, and at the same time you need to get bigger and bigger. I think for us the name of the game is, of course, the more money, the more you can deploy, the larger the tickets, also maybe more diversification you can embed in your portfolio. But if I was to give you an example, last year we had probably 850 million of dry powder to deploy. Early 2020, we deployed at 800 of it, over 18 assets. Some small, like 25 million, some more in the 125 million. So there's a large range. So these are probably the numbers that answer your question.
Yeah. I mean, maybe very quickly on ESG. I mean, how do you implement that? Is that a request from investors, which is becoming more and more imminent?
No, it's a conviction of the group. It's been that's probably why when I was asked to set up that business, there was an appeal, because already in the early 2000s, our group was very convinced of the ESG. It's a conviction of our group. So infrastructure is naturally embedding these ESG components. Having said that, when you build an infrastructure debt platform, 4 years ago we thought, okay, we need to put even more emphasis. There might be a regulatory development, and it is happening actually in 2021, but it was not necessarily a requirement from investors. And likewise, we wanted it to be a conviction because we believed in it, not because we thought we had to do it, because then you are in a danger territory. I won't quote the name. But you have also in the last 3-4 years where we've tried to really implement a discipline process in terms of how we source deals, structure the debt. There are elements of governance that you need to deal with, how we then monitor and report. All that has been done with trying to have a very detailed methodology, a consistent methodology, but at the same time, ESG doesn't benefit yet from, I would say, a common standards or regulation. It's happening, it's work in progress. And I think the introduction, for example, of taxonomy this year, which is happening as we speak, will be a good way for us to have a more common ground. And I think I would just say we're ready for it.
Maybe one final question. Why is infrastructure debt the right investment for institutional investors?
Well, yeah, I think it's one good product for institutional investors. I would say right now, as a fixed income product, it's probably very interesting because you may have much more if you compare it to comparable corporate debt in term whether it's BBB, BB. We certainly provide a bit more security. The default rates are low. Common themes of predictability of cash flows are definitely there. I think it's a good way also for investors to contribute to the real economy, which is a concern. ESG, we mentioned it. There's a favorable regulation. Solvency II 4-5 years ago was designed to especially for insurance company to provide a very favorable regulatory framework. And I think what you can do with these portfolios is create a natural diversification. You can go from one sector to another, one subsector to another, choose different technologies, choose different sponsors, countries, regions, counterparty risk, whether it's a feed-in tariff or government payments or even market risk. So I think there's all that element, equipment suppliers, of diversification. And when you look at 2020 and, for example, COVID, which shook a bit the economy and some portfolios, infrastructure has been resilient, perhaps because the diversification prevented a systemic risk on portfolios.
Yeah. Thank you very much, Jean-Francis, for all your insights.
Thank you.
Let's continue with Grant Harper. So Grant, you are CEO of Investment AG, which runs a portfolio of wind parks across different European jurisdictions. Let's start with a very simple question. Why should institutional investors invest into wind energy?
Well, it gives over the years, and we run this shop for the last 15 years already, and the fund also for 15 years. It always gave our institutional investors in Switzerland a stable form of income, stable performance, stable dividend payments. We were able to pay out dividends every year since 2009, around 4% dividend yield to our investors. Those are particularly Swiss institutional investors, namely Swiss pension funds. We are a Swiss, a regulated Swiss asset manager, doing this business.
You're a specialist provider. You're looking exclusively after renewable power with a specific focus on wind energy, buying directly into different wind parks in different geography, including Germany, Spain, France. And before we go into all these details, I think there is a major difference between onshore wind parks and offshore wind parks, right? Could you explain from an investor perspective what the difference between these two types actually is?
Well, onshore, to put it simple, onshore are wind farms put on land and offshore on sea. So offshore is a lot more risky. So we don't subject our investors to offshore because they don't look for this kind of risk. Offshore can be very profitable. I mean, of course, wind speeds on the sea are higher than on land. Full load hours are higher on sea than on land. That's clear. But many other things are more risky or more costly on sea, like maintenance, a lot more costly on sea. The risk of failure of the investment, being it the bank that gives the loan, or we as the equity party giving the money, can be a lot more risky. So for the time being, and also talking to our investors, we decided to stick on onshore, for onshore. I mean, you see, I mean, in all these years, and we are one of the first players, at least in Switzerland, we could generate like 4.5% to 5% performance for our investors. And this on onshore, and I don't know where it could have gone with offshore. It could have been a non-valeur, no value thing at the end of the day, or the way we have it done. The other thing is, if you go, I mean, offshore investments, offshore transactions tend to be very, very big, very large transactions. And Investinvent and its fund, Investinvent Wind Energy Fund, always tries to keep 100% of an asset and control it for its investors. And if we go to an offshore thing, maybe we are just within a syndicate of many other investors. We don't have a say in everything, in anything, and I don't like that. So I want to control, on behalf of our investors, a wind farm or a solar farm, and I don't want to be just a 5% or 2% stakeholder in a big offshore operation.
So basically, you are trying to control the asset entirely. So typically you try to fully own the underlying SPV, basically. Which
most of the assets in our fund are 100% controlled by the fund, and and the general management is done by our company.
When you go into these SPV investments, I mean, what is actually your leverage rate in terms of at the SPV level?
It depends. You mean the leverage rates? Did you talk about leverage?
Yeah, on SPV level.
Oh, okay. Well, it depends which country. So talking about our traditional countries of investment, Germany, France, it's like 25, sometimes only 17% equity ratio. Talking about Spain, that we just now concluded the first transaction with a big solar farm in Spain. Big means like equivalent by area of equivalent 157 football fields, soccer fields, 157 soccer fields. It's rather 50-50.
Okay.
So it really depends where we are going. Historically, Germany is 25-75.
Yeah. And when you basically, I mean, your leverage providers, are these banks or are these people like Jean-Francis or
No, it's banks. It's commercial banks mostly in Germany or in France, maybe now in Spain, that know the business, that know how to to price the risk of wind or solar energy, and how to add the risk premium to the LIBOR or whatever. And I mean, you see in Germany, the banks still have a big advantage. They can refinance themselves, either through their liquidity given by their clients or by KDW. That's a governmental investment or financing pool. And so we are getting, I mean, just to give you a number, we are still getting in Germany, but I believe also in France, long-term financing, meaning between 15 and 20 years, around 2%. A few months ago, it was below 2% of interest rate, which is, of course, a paradise for the equity part. Yeah. I think Jean-Francis can agree on that.
Now we need to talk. I mean, we need to explain to you how we do. We can price. We can do this. We just need to talk.
Maybe you can give me the money lower than that. But I mean, maybe a word on pricing and performance. So we are trying to buy where we see the market, and that may be interesting. In Germany is like 5.5–6% IRR, something like that.
Okay.
On a project basis.
Yeah. Thank you very much, Grant, for your insights on the renewable power topic. Let's continue with Nitesh from Swiss Re in London. Nitesh, thank you very much for joining the discussion. I mean, you're looking after the infra debt activities of Swiss Re from a UK European perspective. Why is it actually important for Swiss Re to invest into infrastructure debt?
Yes. Well, I mean, I think some of the points have been made by Jean-Francis, which I can concur with. I mean, the asset class has got high barriers to entry, provides long-term stable cash flows to investors. For good quality credits, you have Solvency II benefits, so lower capital charges, and on top of that, you have low default rates, high recovery rates that have been demonstrated over the last 10-20 years. I mean, I think it's also important for us as an insurer that we have the asset liability matching benefits as well from infrastructure debt, as well as being a portfolio diversifier. Most institutional investors have been in public bonds and corporate credit for a long time, and infrastructure debt provides a perfect portfolio diversification tool for a similar risk profile, in some cases better risk profile, because on infrastructure debt you have covenant protection, you have strong monitoring processes, which you don't normally get, and you get a pickup over the public bond in the form of private debt or illiquidity premiums. For all those reasons, it's pretty important for us.
I think Jean-Francis mentioned it earlier. I mean, the Solvency II capital requirements. I mean, you as a reinsurer, I mean, on your infra debt investments, what is your average Solvency II capital requirement?
It's off the top of my head, I wouldn't know the exact figure, but it's lower clearly for infrastructure debt. That is qualifying infrastructure. So that.
So I mean, if you compare it, for example, infra debt versus infra equity,
yeah,
what from your perspective makes more sense?
Now, from our point of view, it's infrastructure debt.
From a perspective.
Yeah. I mean, it's a lot more penal for us to invest in infrastructure equity. So for us to do those kind of investments, the return levels have to be pretty high to compensate for the higher capital charges. For infra debt, provided it's investment grade or above, the capital charges are a lot lower.
Okay. I mean, when you invest, I mean, are you a direct investor or are you going through fund investments?
So within Swiss Re, we started off investing via external managers some time ago, back in 2012. So we've really partnered up with some external managers to source and execute transactions. But when I arrived about 3.5 years ago, we started investing directly. So sourcing, executing transactions in markets that we know well. So, for example, UK and Europe, with stable regimes in terms of regulation, in terms of risk profile. We've focused on those areas as areas where we can access the market directly and source transactions. So it's a bit of a hybrid model at Swiss Re. We still, we'll use partners to source and execute transactions on our behalf where there's value added. So, for example, in countries that we can't reach, so LATAM, for example, US, Australia, and Asia potentially, where we're not on the ground, and we have partners who can access deal flow directly. They've got large teams. They can resource them with the staff they have in those offices, in those regional offices, and can access the market directly. I mean, so for us, it's getting access to as wide a funnel. And we talked about this funnel of transactions. It's a very competitive market, as we all know. We need to cast the net as wide as possible in terms of sourcing transactions.
I mean, we will go into investment and screening process a little bit more in detail in a second, but to what extent are you basically able to source deals through your internal Swiss Re network?
We've done it pretty well. We have relationships within asset management and within our insurance team who also provide a product to the project finance market in the form of an unfunded risk participation product. So we have relationships with banks, with sponsors, with advisors that we've worked with in the past. So it's proven, initially, getting the name out in the market, getting the execution track record, but that's been delivered and we've executed, and we're looking to source more.
Let's go a little bit more in detail into your investment process. I mean, for Swiss Re, what are the most important investment criteria for any type of investment?
Yes, first and foremost, it's risk profile. So credit rating, we need to have, like I said, investment grade rating or above, and we have a tool that we use, which is off the back of the Moody's rating model. But also, we're focused more on operational assets, so assets that have demonstrated a good track record of operational history, good ratio profile, downside sensitivity risk, and less of a focus on GDP related assets. Preferences for as much contracted revenues and OPEX as we can get to make sure that the cash flows are stable. We also have quite a big emphasis on ESG at Swiss Re, and that's quite key in our process.
How do you build that into your investment process?
So we have a scoring system. So every deal has to go through an ESG rating process, and it's similar to how a credit rating score works. And on top of that, each transaction is bottom-up due diligence in terms of any environmental or social or governance issues. And then we have a separate sustainable investment team who monitor our assets and who are there for us to take advice if there are any particular issues that come up on transactions that we need to refer to them on that may be pertinent to that transaction.
So that basically means that within Swiss Re you have a separate team which looks across all asset classes whether investments are being made in compliance with certain ESG requirements, or do you have on top of it certain ESG requirements which are exclusively dedicated to your business, to InfraDebt?
We have both. So it comes from a centrally managed team, but
that
then we have yeah, we have also an emphasis on looking at each transaction on a case-by-case basis. It's actually quite streamlined. I mean, it's not. It hasn't impacted the execution of transactions today.
I mean, one last question. I mean, have you seen any impact from Corona on your existing investment portfolio?
We haven't had much impact. I mean, I think obviously the diligence process, the fact that we've stayed clear of assets that are GDP related or very high exposure to economic downturn has played in our favor. Clearly, transportation assets have been massively impacted, particularly airports. But on the toll road, traffic road side, we're seeing some recovery there. On the port side, we have that hasn't been impacted. So we've fared quite well over the period. I think the emphasis for us is now looking at more renewables, transactions, social infrastructure. That have fared pretty well over the COVID period, as well as digital infrastructure as a theme going forward. We see as key for us to play in as sectors going forward.
Okay, Nitesh, thank you very much for your Swiss Re insights. Robert Jan, I mean, we have heard a lot about infra equity investments as well as infra debt investments. I mean, from a Partners Group perspective, what are your most favorite infra assets?
Thank you very much, Hans. And here it comes a little bit back also to what Dan from JP Morgan was saying, because there's some overlap between what they are doing and what we are doing, and we don't have a completely dissimilar view of the world. As Dan said, it all starts with investing in assets that are essential. Because when you had COVID, what you see is that essential assets get priority also in terms of operations and maintenance, and so that definitely plays to the benefit. I think another element which has been said also by some other participants is low GDP. We consciously stay away from too much GDP exposure, especially if we're coming towards the end of a cycle. And so having an asset with very low GDP exposure has been very beneficial. I think the other thing, which also has been said, a lot has been said already today, but it's about long-term contracted assets, because in the end, what our investors buy is a stable, visible return from us. So that's what we try to give them. And in our portfolio, we have 80% of the portfolio contracted for more than 10 years under take or pay, feed-in tariff, those types of contracts are really providing a lot of stability. So when we had COVID and we saw oil prices coming down to $20 a barrel. We saw gas prices coming down. We saw electricity prices coming down. We saw passenger numbers coming down. It's potentially a very toxic environment for any portfolio, but we're very happy to see that we had a completely stable top line. So I think that's sort of a testament to the way we invest, especially in more difficult times. But really, what we like has been emphasized significantly by COVID, because already pre-COVID, we're very focused on what we call global net zero carbon, and that's sort of a catch-all phrase for anything that helps towards the Paris Agreement, and we see actually significant acceleration of that trend. So our most favorite assets really, tag onto all these criteria that I've just mentioned.
Okay. So and do you have any no-go investments?
Yeah, definitely. I think like every firm, we have our no-go investments, and I won't go to the long list that everyone has. But I think it's important also to note that, especially within the energy space, things have been changing over the past at least decade. I mean, when I started my career, I really thought about, what will be a growing industry over the coming decades. And actually, when I was starting my career, I was thinking about, starting my career in Shell, but I thought, well, maybe renewables is more of a growth story than oil and gas in the long term. And I think that's been actually a relatively good decision that I made back then. And so we won't invest in coal-related assets. We won't invest in upstream of oil or using oil as a primary fuel for electricity generation. I think we only go as far as natural gas, because we see that for the coming decades there is a significant role to play for natural gas in allowing the further build out of renewables and still maintaining grid stability. Grid stability has been mentioned also as one of the bigger issues. So definitely, anything that goes to too much of a classic carbon-based economy is something that we leave to the side.
I mean, with regards to your investment style, I mean, are you trying to go through kind of funds to invest into other funds? Are you trying to go direct? Are you trying to become a co-investor? Are you trying to control the assets? What is your philosophy with regards to governance and control, right?
Yeah, so I think it all boils down to the strategy that we have, and I've been speaking about our strategy being relatively defensive, but what I haven't spoken about is the fact that we try to be the midpoint between a financial investor and a strategic investor. So we don't want to be like the banks in the old days that in infrastructure were just doing a financial engineering game, but we try to be as close as we can to being like a Siemens or an ABB of the world, really having a team which is significantly equipped with people that come from industry and that know how to drive hands-on the value and construct the assets that we work with. So a little bit in contrast to what Dan said and how JP Morgan is positioned, we have a lot of the same philosophy, but we really like to build our assets, expand our assets, and improve our assets very hands-on. And if that's your strategy, it's our belief that you need to have a significant amount of control over the asset. So our strategy is primarily focused on direct and control investments.
Okay. I mean, you have just touched upon kind of the term megatrends or trends in the future. I mean, what kind of megatrends do you see from a Partners Group perspective going forward, and how do you, or what are the consequences for the investment activities of Partners Group?
Yeah, as I said previously, I think the megatrends have been amplified that we're already focusing on. So I think that the core, most encompassing trend that we are seeing is global net zero carbon. And on the one hand, that is the build out of renewables. And as said, I started my career in renewables, and sometimes it feels, especially in Western Europe, like we've already done so much in renewables. But if you look into the numbers and the build out that still has to happen over the coming decades, we at least need to increase the number of installed renewables by 4.5 times. So there's still a very long way to go. And then if you dive deeper into which sort of technologies are poised to funnel that growth, it's especially wind and solar that are going to take the majority share of that. So that continues to be a very core focus of us, to be globally investing in renewables, and we have a very strong track record in the renewable sector. I think being active on the renewables also gives us a very bright view into the other side of the coin, which is the fact that the more renewables we add onto the system, the more inherently unstable the grid becomes. So investing in grid stability needs to come in lockstep with the build out of the renewables. And so there, what we have done over the past couple of years is investing in things like interconnectors. So historically, grids are predominantly a national affair. And by connecting all these national grids, we create a super grid, which allows power to flow over much larger distances and creating stability there. Obviously, battery storage is something that we look at, but at current, it's more of an add-on to renewables projects that we own in order to optimize that renewables project, rather than very large-scale investments into battery storage. And then another part where we are very active is backup power. So these are more traditional energy infrastructure plants, but basically they don't do anything. They just sit there and they are available to provide power as and when the grid operator needs it in order to provide stability. And often there, the contract's also very attractive where you have an availability-based payment mechanism. We do employ a large group of people that do research, and the research is very much focused on generating new investment ideas. And one of those research topics for the past couple of years has been carbon capture and storage. Because if you look at sort of the decarbonization path, there's maybe 4 big buckets of CO2 or greenhouse gas emissions. One is the electricity generation, and we've spoken about that. I think the second bucket of about 25% is the transport industry, and there we're seeing the onset of moving towards a greener future with battery initially, and on a bit of a longer path, also the hydrogen for the heavier transport specifically. So we see there as a decarbonization there. Then in the building environment, which is approximately another quarter, it's the move to heat pumps and solar panels and insulation, et cetera, et cetera. And so there's also an active path to decarbonizing that. But then you're still left with about 25% of emissions, which are generally tied to industry. And I think what classifies that industry emission is the fact that often these industries have to operate at very high temperature points. And to achieve those high temperature points is very difficult with electricity. And so hence being independent from things like coal or gas or oil is much more difficult for these industries. So there, what we are focusing on is carbon capture and storage. So capturing the CO2 at the source rather than letting it enter into the atmosphere, and then permanently storing it below surface. And so this technology has been around for decades, but it's never been competitive against cheap oil and gas. And that's what we are seeing changing very rapidly right now. And we have a live case in the US where we are working on this. And it's really interesting because just the one project that we are working on now in the US will abate more CO2 on an annual basis than all of the renewables we've done over the past 20 years abate in any given year. So the impact is huge of these projects, and those are some of the key trends that we're following. But I'm mindful of time to go into more detail on other trends.
Yeah, thank you very much, Robert-Jan, for all these very, very interesting insights, and thank you very much to the entire panel and for all your very interesting views and positions from different geographies. I think in the interest of time, there is only one question from the audience, which they would basically raise to JP Morgan and Rothschild. What kind of investors do you actually mostly attract with your products?
Sure. So in terms of limited partner investors into the vehicle. Yeah, so we're a long-term strategy. We tend to have investors that are focused on long-term foundational allocations into the asset class. So that tends to lend itself to longer-term institutions like pensions and insurance companies, group plans, groups like that are thinking about long-term allocations.
Jean-Francis?
Same. I mean, 95%. I mean, there's probably maybe some more private clients that are interested because of especially for the more junior debt, there are attractive yields relative to the risk, and the ESG angle is interesting. But I think we're mainly institutions, and I would say within that institutions, probably 75% insurance company, 25% pension funds. However, with the new regulation in Switzerland, we are already attracting more pensions from this country, which is home for us.
Jan, what's your main client base?
Yeah, I think definitely institutional investors. Within that, obviously, we pay a lot to insurance companies, but also pension funds. The strongest base we have is across Europe, especially the UK and Germany. We have a very loyal client base. But Partners Group is a global player, so we obviously attract global capital also globally.
Okay, thank you very much for all your contributions. I think infrastructure investments is definitely a topic for institutional investors. Thank you very much for all your contributions, for joining the panel. Thank you very much to our audience. I hope you will come good over the Corona crisis, and speak to you soon. Thank you very much.
Thank you.
Bye-bye. Take care.
Thank you.